Welcome to a video that I like to call the deep dive video. As I say every week, please don't let this name mislead you. If you're watching this video for the first time or any of the videos that I post each week, I use this in a different context where every week I do daily videos, I do a weekly video, I do an intermarket analysis video, and then at the end of the weekend, I look through all of the daily charts and I put together this video where I go through some of the charts that I didn't talk about in any of this week's videos, because sometimes we can look at this information and get some insight as to what is happening. This is being prepared for Monday, October 30th. The first chart we have, and I only show it in this video because it's a very long-term chart, you do see the VIX on here, but it's invisible, okay? So you don't see the VIX on here. What you do see is a 50-period exponential moving average of the VIX. Now, typically with the VIX, what we do is we have static numbers, 12 to the downside. When we get to that level, that means there's not a lot of fear in the market. And 20 to the upside. When we get to 20 or above, that means there's a lot of fear. Well, the VIX doesn't like to stay within those numbers, and we can go through lengthy periods of time where we establish a different range. You can see over here from about 2008 through 2012 or so, we were in about the 20 to 40 range, and then we dropped down and created a lower range of about 13, 14 or so, with 20 being the upside during this time. And then after the COVID plunged, we set a higher range, and now we could be in the process of setting a lower range. Now this is turning back up because the market's been under pressure and the VIX goes up when stocks go down, and that's why we're seeing this react that way. Another chart where we can look at the VIX is sometimes the VIX doesn't give a real clear indication of what's happening, so we can look at some other studies based around the VIX. Well, on the top, you see a 5-period simple moving average of the VIX, and I look at this every day, pretty much in each video. The middle area is where I look at the VIX to S&P 500 correlation, because sometimes we can get some information from this. We use this chart when it's really spiking up at a really high level. Well, right now it's at a pretty low level, so it's not really giving us any insight. Another chart is we want to see how fast is the VIX moving. And to do that, I use an RSI, which is an indicator, and it's based on 9 periods. Now, again, remember the VIX goes up when stocks go down. So when the VIX is really going up and hitting an extreme reading, that means it's going up pretty far, pretty fast, and we may be getting ready to top out. When we get a really low reading, that means the VIX has been going down pretty far, pretty fast, and we may be getting ready to bottom and actually shift gears and go the other way. We're not getting an extreme reading currently. We did get one not so long ago, back in September, when we were bouncing back up here. That lasted for a few days, and now we've been dropping back down. We're above 50, so there's a little bit more fear in the market right now as this has been going up. But since we're not getting an extreme reading, I haven't been showing this chart. Another kind of measurement of fear is a thing called the skew index. The VIX measures itself by looking at the money options, where the skew index looks at options that are out of the money. And sometimes we can get some insight from this. When this spikes up into the red area, that means the market is anticipating some kind of a big move. Now, we don't really know what direction that's going to be. Some people think we're spiking up, we're going to crash. Well, you can see other times when this spiked up and then started to come down, sometimes that marked a continuation of what was already happening. Other times it marked the top, other times it marked the bottom. So we don't really know what this is telling us, but sometimes we look at this and get some insight from it, but right now we're just about at the midpoint. Another thing is we like to measure the volatility of bonds. That's the MOVE index. We also look at the volatility of stocks, which is the VIX. And then this green line down here is just the spread between the two, and we've been chopping more or less sideways. What I watch on this chart is the bottom. That's the correlation. Our bonds and the volatility of bonds and stocks and the volatility of stocks, are they moving in the same direction or are they moving in opposite directions? And even though this is coming down slightly, they're having a pretty strong tendency to both have volatility right now. Bonds have been going down based on price and stocks have been going down based on price as well. And that's why we're seeing an increase in volatility. It's always nice to kind of see where are we in relation to the all-time high, which was set in early January 2022. That's over on the left. Over on the right, that's Friday's close. And as of Friday's close, we're down 14.55% from the all-time high. We also keep an eye on common stock. Now, the NYSE is made up of all different kinds of things. They break out just the types of stocks that most investors are involved in, and that's called common stock. And we have an advanced decline line based on price, as well as an advanced decline line based on volume. And we've been under a lot of pressure lately, but we're not really breaking down at this point. We are negative, though. We look for divergences, we look for convergences in this chart, and it's really a little bit more uniform, so I haven't been showing this chart that much lately. Another thing put out by stockcharts.com are a thing called technical alerts, and these are automatically triggered. They measure indexes, they measure sectors, they look at other markets, and when something positive happens, it's blue. When something negative happens, it's red. We start at the very bottom. That's last Monday's session. That was the 23rd of October. And we read this going up, where the things that happen near the end of the day or right near the close, they end up being at the top for that particular day. When we see a lot of red, yeah, it means we're having some trouble. When we see a lot of blue or green, that means things are more positive. And we've been down a lot, so you're seeing a lot of red in this overall chart. Another thing that we look at are 5 main indexes. We look at lots of indexes, but the big stock indexes are the Dow, the S&P 500, the NASDAQ 100, not the NASDAQ, but the NASDAQ 100, the mid caps and the small caps. And stockcharts.com has a tool where in an unemotional way, it rates the chart on a scale of 0 to 100. The higher the score, the better looking the chart. And then we look at those charts and rank them from the top down. Well, coming in first place are the QQQs, which is the NASDAQ 100, and it's been under some pressure lately, but it's still coming in first place at 86.1. Now, when I look at a chart, whether it's an index or an individual stock, I want this to be in the high 80s or even the low 90s before I will even consider it. But there are other people, they like to buy on weakness, and they may look for a low score. In second place is the S&P 500 ETF called the Spiders, and it's coming in at 57 flat, where we've been seeing some weakness lately in the S&P, and so that's why the score is going down. The Dow comes in third place at 47.4. It's been under a lot of pressure lately. And then in fourth place are the mid caps, and they're really under a lot of pressure now, coming in at 23. And the last one we look at are the small caps, and this is represented by the IWM, which is the ETF for the Russell 2000 index. And they've been really weak lately. In a good, solid environment, we want to see the small caps doing well. They're under a lot of pressure right now, coming in at 14.3. Then we have some short-term charts to look at. This is a short-term rainbow, and the lines that you see on here go from a 10-period moving average up to a 50-period moving average, and I have them different colors, so they kind of look cool. But you can see as we've been going down, we're underneath most of the lines in this short-term rainbow, and naturally that just shows that we're negative. We also have a double and triple exponential moving average. Sometimes I show these charts all the time, but this is based on 20 periods, and you can see where we're really coming down and we're declining. So I haven't been showing this chart because it's not all that relevant. Another thing that I have been showing, and it's a different color on the chart that I usually use, is this is an anchored moving average going back to the all-time high, and we've been breaking below that. You notice for most of 2023, we've been above it. And so this is pretty significant support that we're falling under right now. There's another anchored moving average going back to the COVID low. And if we get down to that level, that may also act as support. Then we have a regular 20-period simple and exponential moving average, and we're well below them right now, so I haven't been showing these charts. The one thing that's kind of negative is the blue line, which is an exponential moving average. It moves faster than the red line, which is a simple moving average, and it's crossing below. That means that we're going down pretty fast these days, and since this is declining, that means our short-term trend continues to be negative. Some intermediate-term charts. Here's another rainbow chart going from 50 periods up to 100 periods in how it's calculated, and we're below all of the lines, and the lines themselves are starting to roll over. Sometimes I use these charts in the daily video, sometimes I don't. It's like, are we really getting anything out of this? And so I typically will just save them for this particular video. We also have a 50-period double and triple exponential moving average. We're also dropping down below this anchored moving average, just like we saw in the previous chart. The red line and the blue line here, we're falling down below them, and we have the red line below the blue line, and that means that we're going down pretty significantly in the intermediate term. Then we have a regular 50-period moving average study, and the blue line is already crossed below the red line, and we've been declining and we're far away from these, so I haven't been showing these in these moving averages. We have a 100-period moving average. We were holding up fairly well in between the simple and exponential moving average, and then we broke down below it, and we're far away from this moving average, and so I haven't been showing this. If we do finally hit bottom at some point and start to go back up, these moving averages that I've been showing you may end up acting as resistance. Then we have a Connors RSI, which is an oscillator, very similar to a regular RSI, where we look for an extreme positive or negative reading. When we're below the dashed line and declining, that's negative, and that's what we're getting right now. You could say this is a short-term indicator because it gyrates all over the place, but we don't get an awful lot of signals from this, so I tend to keep it more in the intermediate term category. Now we have the McClellan oscillator, and I will go through periods of time where I show this quite often. Now we look at an S&P 500 McClellan oscillator just for the S&P. This is an NYSE McClellan oscillator, which is a broader range of what the market's doing. And we're negative with this right now. We're below zero and declining. When I will start to show this chart is if we continue to decline and we get down to this negative area, this minus 80 area, that's when we're starting to get extreme negative. We're getting to that point with the S&P 500, but we're not there here with the broader market, at least yet. Then we have the Copic curve. And I tend to only show this when we see this crossover positive, when the black line goes above the red line. That's a buy signal. Now, this is also a momentum oscillator, so I probably could show it. I'm not used to doing it that way. When the black line crosses below the red line, that signals that the momentum based on this indicator is also negative. Then we have the %B indicator. Up on top are a thing called Bollinger Bands, which are very popular. It's one of the first things you learn in technical analysis. And you'll see up here on top that we spend very little time going outside of the upper band or down below the lower band. The %B indicator measures how far are we above or below the upper or lower band, because sometimes we get an extreme reading. Like back in September, we had an extreme negative reading. And then other times we get an extreme positive reading. It just means the market's going pretty fast at that point. Now, we can also have a bias based on this indicator. When we're below the midpoint here and declining, that's negative, and that's pretty much what we're showing right now. And we're close to the lower band right here, but we haven't actually closed outside of it. Then we have an Ichimoku cloud, which some people really like to use this as support and resistance. All this is a series of moving averages that are then shifted forward. And we were inside the green cloud here in the latter part of August and into September, and that was, you could say, providing support. Well, now we broke down below that, and we're well below this red cloud, and the red cloud is starting to go down. So if we ever do hit bottom and start to go back up, this may end up providing resistance. And since we're far away from the cloud, I haven't been showing this in the videos. And we've also been watching what I call here just a regular 50-day cycle. And there's nothing magical about this. There's people that have 21-day cycles, 73.495 cycles. You can do anything you want. It's just, it seems like over the last year or so, a 50-day cycle has been fairly helpful. And we're well into this new cycle now, so I've stopped showing the chart. Now, sometimes when we hit the end of a cycle and start a new one, sometimes that marked the top, sometimes it marked the bottom, sometimes the market just ignored that altogether. But we just want to know this is happening, and so we can be aware of this. You can also see this blue line on here. That's a support level that was set on here a number of months back because there's an awful lot of open futures contracts on the S&P right at this level that if we really break below this, that could really speed things up. And we also keep an eye on the S&P 100, which are the biggest stocks that make up the S&P 500. And we're just seeing now that they're both going down. Earlier in the spring, we did see a divergence here where the S&P was pretty much going flat, where the S&P 100 was making higher highs. We noticed that, and that ended up helping the market to actually go higher. We're not really seeing anything right now, so I haven't been showing this chart. A long-term rainbow chart goes from 50 periods up to 250 periods, and we're coming down. The lines take longer to roll over, but we're getting all the way through. We're slicing through the lines on the rainbow and actually falling below it. And that is also looking more negative. We also have a 20-period simple moving average of an open, high, low, and close. This is an indicator that I developed decades ago that I used around a basic trading system that I had at that time. And I don't do the trading system anymore, but I ended up keeping the indicator because this is a little more helpful than you might think. Naturally, if this mini rainbow is going up, that's positive. If it's going down, it's negative, and that's what we're saying. But we can use this sometimes. If we're going down and then we start to bounce back up, sometimes one of these lines will act as resistance. If we're going up and we bounce down a little bit, sometimes one of these lines will act as support. So when we get close to some of these lines, I just like to bring up this chart and show it just as an idea of either support or resistance. Then we have a weekly chart of the S&P on the top and the weekly chart of the German DAX. That's their main index in Germany, right here in the middle. And we're seeing right now that the correlation between the two is quite strong because the S&P has been going down and the German DAX has been going down as well. And so that's why this correlation is really going up. So we keep an eye on what's happening in the EU and specifically in Germany. Some support and resistance. I've been using these a lot lately. In fact, yeah, I don't even have any charts to show you this time. They've all been used because we're breaking below some pretty significant support at different levels and on different indexes. Then some broad market measures where we have the VIX that measures the S&P. The Vixen looks at the NASDAQ 100. And I don't use this upper chart all that much because these look like icicles falling off a roof. I look mainly at the line chart. And you can see where we're above the moving average and the moving average is going up. As the NASDAQ 100 has been under pressure, we see fear really starting to increase. This is a weekly chart of the QQQs, which is the NASDAQ 100. We have an anchored moving average going back to the all-time high. And even though we've been dropping, we're still above this anchored moving average. So this support level is holding. We're breaking this anchored moving average on the S&P, but we're still well above it for the QQQs. The bank ETF, the banks have been under a lot of pressure since last March, and we pretty much have been chopping sideways since then, and we continue to be in a downtrend. We look at the regional banking ETF and then do a ratio with the financial sector. Both have been just getting hammered, but the regional banking ETF is even doing worse, and it's really underperforming. Then we look at a ratio between the QQQs, which is the NASDAQ 100, and the diamonds, which is the Dow. And I look mainly at the bottom where you can see here that the correlation is fairly strong. So if the Qs or the NASDAQ 100 is going up or down, generally the Dow is doing the same thing and vice versa. Some rate of change charts, these are very long term. These are based on 250 periods where we look at right now and then we go back 250 periods ago and then say, okay, how have things changed since then? And we've been in a decline as the market's been under pressure. Here's a longer term look at that same chart going back to 1980 where we have been declining. We're still above this zero line here, so we're positive, but we are declining. And if we drop below that, that's going to turn things more negative. Keeping an eye on some different bond charts. We have a thing called TIPS, and these are Treasury Inflation Protected Securities. These adjust according to what's happening with inflation. So when interest rates are going up and inflation is a real concern, people are getting into TIPS. And you start to see this really going up in this ratio. When people aren't as worried about inflation, they don't get into TIPS and they start getting into 3 to 7 year bonds. Well, this is really starting to come down, showing that there's not a lot of inflation worries right now when you just look out 3 to 7 years. However, look at the next chart. When we go further out and look at longer term bonds from 7 to 10 years, there are inflation concerns, and this ratio is continuing to go up. And so looking further down the road, people in the market are concerned that inflation might be a problem. Then we look at a correlation between the S&P 500, which is in red up on the top, and the long-term bond ETF, which is in blue. And you can see they're both going down. You can see that just by looking at this. Well, over 50 periods, they have a pretty strong correlated relationship. But when we look at their 10-period relationship here, it's starting to drop a little bit, where we're seeing a little bit of divergence in the shorter term. Down on the bottom, these are just different ways of measuring the spread between these two areas on the upper chart. And then we look at a value to growth ratio, and that's represented in black on this chart. And then the 10-year yield, and you can see they're really going in opposite directions from each other right now. So we look at the correlation, and we're right about in the neutral area. When we're at this red line down to this blue line, I call that neutral. If we break above this, that means they're going in the same direction. If we break below it, that means we're going in opposite directions. And then we have another ratio of the Qs, the NASDAQ 100 to the long-term bond ETF, and they're having a pretty strong correlated relationship. They both have been under pressure lately. The Qs have been going down and the bonds based on price have been going down. So that's why we're seeing a fairly high reading on this chart. Then we look at a 1-month yield and we subtract a 3-month yield. Now, when things are normal, we should always get a negative answer. And that's what we're getting right now. When we get really weird, like this big gyration, this was during the debt ceiling crisis earlier last spring. Well, we continue to be negative right now, which means the market is not freaking out about anything in the short term. There's plenty of other things to freak out about. Now, we don't know if this is going to turn into something or not. This is the 3-month yield, and we topped out back in 2007 and then rolled over into the great financial crisis. Well, we've now gone above that level, and what I've been watching for is to see if this tops out and starts to come down, and will that be a warning? But we're also seeing a change in the interest rate environment where we might go from something different than what we've seen over the last 40 years, where we get into a higher interest rate environment where this could continue to go up even higher than where it's at right now. So we'll keep watching this. We'll see if what happens if this does roll over and start to come down. Is that going to give us a signal, or are we going to just be able to discard this at some point in the future? Then here's a chart of all the different yield curves that I follow. We still have the 10 to the 2 and the 10 to the 3 month that are inverted, but they're starting to show some improvement. If you watch the daily video from Monday's session, I showed just breakout charts of these two areas here, where the 30 to the 5 and the 10 to the 5, they're actually going back above zero and they're no longer inverted. We're waiting to see if these go back to being more normal. That's usually when you start the countdown to see, are we going to go into a recession? Then I have a thing called possible positive scenarios. And I use a lot of these charts when we're going down and possibly setting some kind of a bottom that we can bounce up out of. And I've been using a lot of the charts in the videos lately. This chart is looking at the percent of stocks in the S&P 500 that are above their 200-day simple moving average. We can use this like an oscillator. When we really get ripping down or ripping to the upside, that'll give us an extreme positive or negative reading. When we are not getting an extreme reading, generally if we're below 50, that's more negative, and that's where we're at right now. When we're above 50, that's more positive. So really, this is kind of telling us what we already know, that the market is negative. Then we look at the 2-year treasury yield, because sometimes when this gets done going up and then starts to come down, like we've been waiting for the 3-month, this will often give short to intermediate term support to the S&P. The problem is they're both having a pretty strong tendency to go in the same direction right now. So it really isn't helping us that much. All right, so thank you. If you want to see the rest of the charts, this is not meant to be a standalone video. Please look at the daily videos and the weekly videos and the other videos that I post. I hope you found this helpful. Feel free to leave any comments if you would like. I hope you have a really good weekend, and I will talk to you in the next video.